Nicholas Bornolis of Capital Inc., and I am again privileged to welcome you to another terrific panel. This panel is not focusing on sector fundamentals as most of our panels so far, but it's focusing on corporate strategy, which is a very important, actually every shipping company has to deal with corporate strategy, and we have with us four major industry participants sharing with us their insight on corporate strategy, capital allocation, diversification, fleet renewal, and so on. I will turn it over to Ted Jadick, our partner for the conference and conference chairman, who is going to introduce our panelists. I would only like to say that Jerry Kalogiratos of Capital Product Partners, who was supposed to be on this panel, cannot be, even though he would like to. As we all know, they publicly launched a bond offering, a Eurobond offering in Greece, and therefore he cannot be on a public panel while the bond offering is going on. So without any more delay, I will turn it over to Ted. And again, thank you to all the panelists for being on this great panel.
Thank you, Nicholas. And good morning again, everyone. Let me briefly introduce the panelists. We have George Achniotis, CFO of the Navios Group. We have John Wobensmith, CEO of Genco Shipping and Trading. We have Ulrik Andersen, CEO of Golden Ocean Shipping. And we have Paulo Almeida, a co-chief investment officer with Tufton Investment Management Limited. Good morning, guys, and welcome. Thank you for participating on the panel here. So we have, my standard introduction is we have 50 minutes allocated. We have 4 mouths to feed. I'm going to start with questions that I will ask all panelists to address. And then we've got some individual questions for each of you, and we'll see how much time allows for those. But we'll plan on a mix of both. So, charting corporate strategy. Interesting topic. A lot of dynamics in the market these days, the usual, plus the growing pressure and influence of regulation. A lot of it having to do with decarbonization. So I think charting strategy around all of these different elements, I'm sure is a more challenging job than maybe you had 2 or 3 or 4 years ago. Let's start with capital allocation strategy, if we could, and could each of you guys talk about kind of the key elements in your respective strategies? And John Wobensmith, let's start with you, please.
Okay. Good morning, Ted. Thanks for hosting this. It's been a while.
My pleasure. Good to see you.
Great. So our capital allocation strategy is built on basically 3 main pillars. A high dividend payout model, which we're going to be putting in place in full in the first quarter of 2022 basis fourth quarter's cash flows. Deleveraging, which we've done quite a bit of this year. It's not just been a factor of the market going up in terms of asset values, but if you look at what we're targeting in terms of our debt outstanding at the end of the year of $250 million, that means we will have paid off 44% of our debt since January 1 of this year. So deleveraging has taken place from asset values, but we've actually been paying our debt down significantly as well. And then growth. We do still feel it's a good time in terms of return on capital to do fleet renewal, which we've done quite a bit of over the last 18 months, as well as looking at new transactions. Just going back to the dividend for a second, because it is important. Our view is that it needs to be sustainable through any cycle, which is why we are delevering in a very major way, ultimately targeting a medium term of 0 net debt. And we're also establishing a reserve that will build up on a quarterly basis that we can use for fleet renewal, smoothing out quarterly dividends or share repurchases. And we believe this model should work very well. We feel that there's already a tremendous amount of operating leverage built in naturally to the shipping industry. And taking the high financial leverage away, we just think presents a much better risk reward model for shareholders and investors.
Thank you very much. Ulrik, let me direct the question to you, please.
Yeah, thank you, and thanks for having me on the panel here today. I'll be quick for Golden Ocean on the capital allocation strategy. It's a fluid thing. It's something that is changing over time, but essentially what it comes down to is creating a shareholder value in the short term and in the long term. I'd say we have this year grown our fleet quite aggressively, while we have also paid out dividends. So we've tried to balance it. I think where we are seeing the world now, or how we see the world now, is that we have sort of placed our bets. We have increased the fleet to the extent that we wanted, and now we are looking more towards making money, and of course also paying out dividends, which is an integral part of our strategy as well. So our focus has shifted a little bit from growing to now what can you say, harvesting, I would call it. So that's shortly how we are positioning ourselves at the moment. With regards to leverage, I can just quickly say we are around 50%, maybe slightly below that debt to equity, and we feel that is a good place to be. So most of our can you say cash that we're generating is going towards dividends.
Thank you. George Achniotis, could you address the question, please?
Yeah, thank you, Ted, and good morning to all. I mean, this year was a transformative year for Navios partners. We have transformed into a diversified company with presence in dry bulk, containers, and tankers. We believe that the diversification will allow us to invest in the right sector at the right time. I think we will all agree that the best opportunities appear at the lower part of a cycle. That's when companies should want to expand when asset values are low. And we see that as the main weakness of pure play companies, that at the bottom of the cycle, it's more difficult to expand. Leverage increases as asset values reduce, cash flows are stressed, and as charter rates drop. So it becomes more expensive to raise capital and more difficult to obtain financing in order to be able to grow. And we have seen companies, buy assets at inflated prices at the top of the market and selling at the loss at the bottom of the market because they had to raise liquidity. So our diversification allows us to generate more predictable cash flows over time, capitalize on cross-segment opportunities, and grow accretively at the right time. Our intention is not to call the top or the bottom of the market precisely for each cycle, but to make sure that directionally we're in the right zip code every time.
Thank you. Paulo, you are representing a little bit of a different vehicle here, being an investment manager with managing private equity funds of clients, and as well as a listed vehicle listed in London. How do you think about capital allocation on kind of a broad level?
Yeah, thanks, Ted. So that's quite right. Although we do have some significant elements of both what John mentioned and George mentioned as well. We've invested about $1 billion since early 2015. About 2/3 of that has been in a couple of private funds that hold diversified portfolios of ships. And about 1/3 of that, a bit more now, is in our London listed fund, Tufton Oceanic assets. All of those funds have diverse portfolios. I mean, very roughly, the Tufton portfolio at the moment is actually about 1/3 each tankers, container ships, and bulkers. nearly all the vessels that we have are what we call small to mid-size workhorses. We only have one bulker larger than Ultramax. We have quite a lot of, we have about 25 in total, Supermaxes, Ultramaxes, and handy-size. In the tanker sector, we've opportunistically invested in Suezmaxes a couple of years ago, which was, great timing. We didn't call the floating storage boom, but we thought that values were very attractive in mid to late 2019, and we've actually exited most of those assets in the meantime and produced very, very good returns despite having little to no leverage on nearly those assets, on nearly all of those assets. But the focus over the past few years since the IPO of our listed fund has been on that vehicle, which now has about a $400 million market cap. It was the first London listed shipping company of any sort, shipping exposure. We're not really a shipping company, but a shipping exposure in the London market for many years. And we're the first listed shipping fund and possibly the first listed shipping fund in the world. That portfolio is also roughly, as of now, about a third each of the three main segments. We have very little leverage. It's less than 10% net leverage. In that vehicle, we have just about 2 years of average charter coverage. And the key element of that strategy, though, that's facilitated by those other elements of the strategy, is that we pay a high and fixed dividend that produces roughly about a 7% dividend yield. So we pay a fixed amount per quarter. We've actually raised our dividend twice this year. Clearly that yield, which is fixed, the dividend, which is fixed on a share price that moves slightly, means that the yield moves a bit, but we're targeting about 7%. And that's the key thing that our investors, at least in the London market, are buying, is that very visible dividend. And also they find shipping attractive because historically it's been a very good inflation hedge. Our investors were concerned about inflation even before the COVID impact and supply chains. And also they see it as an attractive diversifier in that it was very difficult, if not impossible, for many European investors, and especially in the UK, to get access to shipping as an asset class until we listed our fund in 2017.
Thank you. Okay, I'm gonna shift to some specific individual questions, and Paulo, I'll stay with you, and I think you were touching on it. The London listing is different. It's unique. Many of your peers, if not all, are listed in other venues. New York, Oslo being, I guess, the primary other two markets. Why London, and what are the benefits from the company's perspective and the investor's perspective?
Sure. So, part of the reason in London, of course, is that Tufton is headquartered in London. So, we're considered very much part of the investment community and the maritime community here. It's, one of the major maritime hubs. The key reasons, however, are one, that in the UK, there is a quite significant listed fund market. Clearly, closed-ended funds also exist in the US, and Capital Link had a conference on closed-ended funds and similar investment vehicles last week or 2 weeks ago, in which I participated in. But within the London market, it's a much bigger portion of the overall market cap of the London Stock Exchange. So we have quite a large universe of alternative investment funds. We have a couple now in shipping because we came to market in 2017. There's also now Taylor Maritime Investments, which is so we are diversified. They are focused in handy-size bulkers. We have two music royalties funds, which I'm pretty sure don't exist in the US in listed format, but are available to private investors. And we have, dozens of infrastructure funds, both equity and debt, some focused on specific sectors like solar, student housing funds. So there's a very mature market here for mid-sized investors, so smaller charities, very large family offices, and some of the traditional long-only investors who are looking for these diversifiers. And because there are quite a lot of these in London, we're pretty well researched as well, which has been has probably been a struggle for the shipping industry in New York, less so in Oslo, but in New York over much of the past 5 or 10 years, when the research coverage, although now it's expanded again, it has been quite limited for a lot of that period.
Thank you. Thank you. John Wobensmith, let me shift to you. And we had a panel yesterday on the dry bulk on the dry bulk market itself. I think the pretty uniform consensus is things look to remain robust. I want you to talk about, if you would, how you see the dry bulk market fundamentals looking forward, but kind of in the context of the corporate strategy topic. What is your outlook, and given that outlook, how do you think about the company's strategy over the next 2 to 3 years or longer?
Yeah, I mean, so look, I unfortunately I did not have a chance to listen to that panel yesterday, but I do understand it was quite bullish for the next few years. I would agree with that, and I think we can also all agree, while the demand fundamentals are strong, this is really, in my mind, more of a supply story, and the fact that you've got a historically low order book, and you're effectively not able to order until maybe you can get delivery late 23 or early 2024. So the supply side looks very much intact. You just do not need a lot of demand growth to continue to build off of what we've seen this year in terms of demand outstripping the growth going forward. Asset values have moved up. There's no doubt about it, and they've moved up quite substantially, but they still seem to be playing catch up to rates and what you can do in the time charter market. 5-year-old vessels you can put away under 2-year charters and pay off half the purchase price today, which we have done with some of the ships that we purchased 5 or 6 months ago. And so you're able, again, to de-risk very effectively. Again, while we're focused on fleet renewal, we're still focused on growth because of the compelling return on capital. The de-levering and getting ourselves to that target of 250 at the end of the year is very important. And I think we're well on the way to that target. And again, I just go back to the risk reward model of low leverage and a high dividend payout structure. George touched on some interesting mistakes of the past that companies have made, and I would say Genco certainly was part of that a decade ago. But high leverage combined with unsustainable dividends, it doesn't work. And so and dilutive equity offerings don't work when you need to raise cash because you're too levered. And then adding to the new building order book, that doesn't work. So what we've tried to do is take those mistakes and form the company so that we don't ever have to go down any of those paths again, and deal with set the company up for low leverage in a continued volatile market, be able to return cash to shareholders consistently on a quarterly basis. The worst thing you can ever have to do is, that we all know, is turn off a dividend. That is death. And so, when we push our cash flow break-even rate down to the lowest in the peer group, which will be in the low $7,000 a day, there are very, very few markets, and they're usually very short term, where you would have negative operating cash flow if you look back 20 years. So that's our main focus. Again, I still think the market is attractive for acquisitions, but I do like the ability to de-risk those with a first-class charter, and bring that purchase price down over a 2-year period.
Follow-up question. If you can find a good quality modern secondhand vessel in the market and lock up that charter, why can't the existing owner do it? I mean, I would just think that's a challenge. It must be challenging to kind of shake free attractive vessels in the secondhand market in a market like this.
Look, it's still a liquid market. I mean, there are, I would say there are less eco capes, if you will, or Newcastle maxes for sale. But when you get down into the Kamsar maxes, the Ultra maxes, it's actually fairly liquid. There are still plenty of assets that are available. And again, I look at the proposition of, do you go out and order a new build versus, dip into the secondhand market if you want to grow? And I mean, you can just take a resale Kamsar max, and again, you can pay off 25% of that in 1 year, and you're well below anything on the new build front. And you don't have that risk that you're sitting out there for 2 years, and you're certainly not adding to the fleet. Yeah. So, and I think this was a big topic, actually, from what I understand in the dry bulk panel, and I think everyone agreed that definitely got to stop the new builds. You just can't get tempted, and there's plenty of environmentally friendly tonnage out there that you can still acquire.
Yeah, thank you. All right, so there was a clear consensus on new buildings in yesterday's dry bulk panel, and so this is a natural flip to you, Ulrik, because as you mentioned, you guys have grown the fleet significantly in 2021. A large transaction involving your affiliated company, with I believe involving 18 vessels. But then you actually went out and did order new buildings. So I'd be curious if you could kind of walk us through the thought process around each step.
Yeah, no, it's correct. We have grown substantially this year. As you say, we have increased the fleet with 25 vessels. It's a 33% increase, so transformative for sure. That said, we have still managed to pay out 150 million in dividends as well, should I say, for the first 6 months. So, it's been a testament to how strong the market has been. I guess also our priorities. So I feel like the black sheep here on the panel, having ordered recently. But let's remember, the 18 vessels were already on water, so they were certainly not new builds. And now, yes, we have pulled the trigger for seven Kamsar maxes. So that was, I think, you need to see that in a light of a general renewal of the fleet. We have 100 vessels, and what can you say? 7 vessels is not a huge order for us, but what it does is that it paves the way to release some of the older tonnage that we have, to divert some of that. So I think what our approach to this has been that, okay, we went into this year, we increased the fleet, we have added some extra later, but average we have picked a pretty good price point for these vessels, and for us now, the needle is moving from buying to selling. We will always look for attractive transactions, but I think that pool is drying up somewhat, at least from our perspective, and certainly on the Cape-size vessels, which can you say are maybe the ones that we would like to focus on. A little bit more on the Kamsar maxes are still out there, so, as John says, but the Cape market, there's not much modern tonnage to be found. So, so I think our approach has been that, place some chips on the table, because we believed in this market, and now we have done that. I would say that we have probably also done contracting more vessels, and will now, as I said earlier, harvest what we can.
One more question on the new builds. The material I read said that they were dual fuel ready, and I'm just wondering if you could elaborate on that a little bit further for us.
Yes, I mean, we did simply not find it attractive to pay an extra $10, maybe $12 million for dual fuel engine. I mean, there's no doubt dual fuel technology is, is better than conventional engines. But it is still not zero emission, and the jury is still out as to whether this will be the future-proof solution. So instead of spending a lot of money with so much uncertainty, we decided to buy time. We expect more visibility going forward, and we also expect technology to become cheaper. So, and I think just, it's important for me to say that the vessels that we are buying are coming with all the bells and whistles. They are rated what we say B+. Like we know from our refrigerators at home, it's the highest rating you can get if you are not a dual fuel. And our technical department has assured me that they will retain that for 5 years. So these are vessels that will buy us, 5, 6, 7 years at least before we need to make a decision even on this. So I'd say if we get in trouble with these vessels, there's a lot of owners out there, actually including ourselves, that would have a lot of challenges. So shortly, yes, we bought ourselves time to see more visibility and hopefully also find the right solution at a cheaper cost.
Thank you. Thank you. George, I wonder if you could maybe take a little bit of a deeper dive into the transaction that Navios announced earlier in the year and that you were alluding to in your opening comments, and kind of go through in a little bit more depth as to how you think about it and how you think about it in terms of positioning the company going forward from a strategic point of view.
If you allow me first, I want to brag because we have grown
please.
NMM by 3 times since the beginning of the year. So the transaction with NNA was, of course, a transformative transaction because we diversified, as I mentioned earlier, into the tanker space. We created the largest US publicly listed shipping company with over 140 vessels. And they're almost evenly split between dry bulk, containers, and tankers. So the result, as we see it, is a stronger, more resilient company, which can mitigate sector-specific cyclicality, capitalize on cross-segment opportunities, and provide predictable returns to the stakeholders. Now, we see 3 major benefits of a large diversified company. The first is the balance sheet flexibility. We have a low leverage, which should not be materially affected by the volatility of any one sector. NMM before the merger with Navios acquisition was at about 30% leverage. After the merger is at 35%, and we intend to bring it down quickly down to 30% again. And again, if I may compare that to a pure play company, even if you are relatively low leverage at 40-50% at the top of the cycle, once the market turns and asset prices drop, you can easily become over levered at over 70-80%. And as I mentioned, at that point, it becomes very expensive to raise capital and difficult to obtain financing in order to be able to grow. The second major advantage that we see is in terms of our chartering strategy. So we have the flexibility to optimize our earnings. I think everybody in the panel will agree that the container sector is almost at its top right now. Dry bulk follows, and the tankers are still lagging behind. So what we have been doing in terms of our strategy, the chartering strategy, we have been fixing on long-term charters at very attractive rates all our containers, and this provides us the cash flow visibility going forward. And more importantly, it reduces our break-even costs per open day for the whole fleet. And this allows us to play on a shorter charter on a shorter term basis, our dry bulk and tanker vessels, in order to be able to capture the upside as the market recovers. And the third is what we discussed in the first question, the capital allocation. With more predictable cash flows and low leverage, we have the flexibility to buy and sell assets at the right time of each segment cycle. And this is what we have done also with NNA. I mean, the tanker sector was at a low point. The transaction was well-timed, it was opportunistic, and it offers a significant upside to our unit holders. And as a management team, I think we have a good track record of completing successful combinations. I mean, at the beginning of the year, we combined Navios containers with Navios partners. Again, It was at a time when containers were still relatively low in terms of asset prices and earnings. Since then, container ship values have grown by 3%, and charter rates have gone up by 4 or 5 times. And this has resulted in an expansion of the NAV of Navios partners. And as a consequence, we have seen a 400% increase in the share price of the company since we announced the transaction with Navios Containers. And we expect further appreciation once the tanker market begins to pick up. So to conclude, what we are trying to do is create an entity that provides an investment platform to a wider group of investors that are looking for exposure in the world trade and the global economy. I mean, the 3 sectors that we operate account for about 80% of the world trade. So the company and the stock now can become a good proxy for world trade.
Thank you. Okay, I'm going to shift back to a question that will go to all panelists, and that's around, again, it's linked to the strategy, but it's differentiation, and how do each of your companies look to differentiate itself in the market vis-a-vis your customers, vis-a-vis the investors. Where are your competitive advantages? And I will start with Ulrik, please.
Yeah, thank you. As you mentioned, it depends on where we are talking about differentiation, if it's vis-a-vis our customer or the investors. I think it's probably most relevant to talk about the investors here today, and it also ties into the strategy discussion we are having. But for Golden Ocean, I think there are 3 main areas where we feel we differentiate ourselves. We focus solely on large-sized dry bulk shipping from Panamax and up. We are the largest owner of Cape-sized vessels. We have 56 of them. And that is important because the Cape market is where we see the largest upside, both on volumes, on values, asset values, but also on freight. So if you want to be exposed to that, then you want to own Golden Ocean. We also have, maybe I can fight with John over this, but we believe ourselves the lowest cash break even for the Cape-sized vessels, 12,700 per day. And that is an all-inclusive cash break even. It's amortization, it's G&A, it's OPEX, it's the whole shebang. It gives, of course, a lot of possibility to tap the upside, but it also gives some downside protection because the rates are usually above that level. Certainly, when you account for the fact that we have scrubbers on our vessels, we have a more modern fleet that you will need a lower Baltic for us to achieve 11,700. So those are the two ones. The third one is I think actually as I mentioned a little bit in the beginning, we focus largely only on the large sizes, so we are pure play. And as opposed to George, I think that is a huge advantage for the investors that they can, decide their own exposure to the market that they want to. If they want to have tanker exposure, they can buy Frontline. If they want to have dry bulk, they can buy Golden Ocean and Maersk if they want the containers, and makes it around themselves. So I think that is an advantage, but surely I buy the arguments, and I think it depends on the investor time. But that's at least what we would be saying. So the final thing is that we remain spot oriented as long as we believe in the market. Today we have around 25% cover at around mid-30s until the end of Q2 next year. The rest is spot. So it offers our investors a relatively clean exposure to the large sizes, and of course what we make we share with our investors through dividends, and that's that. So briefly, Golden Ocean is clean exposure to large size bulk shipping, low cash break even, and aggressive dividend policy.
Quick question follow-up. Is the 25-75 then mix which you have today, is that one you would see continuing with, or depending on the market, could that shift to a heavier component of fixed cover? It
could definitely shift, and I mean that is a fluid. that's a snapshot right now, but I don't see why we would not try and what can you say, safeguard even more against the Q1, which is likely to be a bit lower than the rest of the year.
Thank you. Thank you. Paulo, how would you talk about differentiation as it comes to your activities?
Yeah, because if we focus on what we're doing with our listed fund, our peers, we now sort of have a peer in that, as I mentioned earlier, Taylor Maritime is also listed in London, but really our peers are those other alternative investment funds and asset classes that I mentioned. So we differentiate ourselves by producing a strong and sustainable dividend that is significantly higher than is available in nearly any asset class today. We've seen yields compress and prices increase in nearly every asset class in the world. We saw this from 2013-14 for the next few years. Clearly COVID had an impact on that, and then we've seen all of the negative COVID impact not only reverse but even tighten, where almost every asset in the world is now at some sort of record measure based on Tobin's Q or based on yields. And so shipping, although as we've noted, and lots of other people have noted, asset prices have come up other than in tankers. So bulkers have come up quite a lot, as John mentioned, and container ships have risen dramatically. There are still pockets of value in shipping where you can get strong and sustainable yields that are just not possible in other asset classes. To be able to offer an investor a 20-25% unlevered yield on a handy-sized bulker or an Ultramax bulker is something that's just really not possible in other asset classes. And when you combine that with the historic advantage of shipping in it being a good performer in environments of high inflation, which a lot of multi-asset investors are concerned about, and also the decarbonization upside that there will be in shipping. That's what we're offering to the UK investor base.
Thank you. John Wobensmith, how about Genco?
Well, look, in terms of fleet, we take a barbell approach where we think it's very important to have direct exposure to all of the commodity classes. So we have a fleet of 17 Capesize vessels, and then the remaining fleet of 44 are in the Supra and Ultramax sector. We like the meaningful upside that is offered in the Capesize sector, but we also like a little more of the stability in the Ultramax and Supramax sector to balance that out. So I think that is somewhat of a differentiated approach. We have very high corporate governance standards, and I know that a lot of people talk about this, but the reality is we were ranked number one in Weber's most recent corporate governance and ESG scorecard. Really overall, it's not just governance. We've always been in the top quartile, but we were very happy to be ranked number one this year. And I think that, as a U.S. filer, really of only one of two U.S. filers, I think that's something that is very important. And then again, I'll just go back to our debt structure. By the time we get to the end of the year, we will have paid off 44% of our debt that we had on January 1st at the beginning of the year. So a very meaningful delevering. That $250 million target is 60% of the scrap value of our fleet today, or the other way to look at it is the scrap value of our fleet today covers that debt outstanding by 1.7 times. So it is a meaningful delevering event. It is to set the company up, as I said before, so that in any market or anything the market can throw at us, that we have the ability to continue paying dividends. I will push back on Ulrik a little bit because he baited me. So our break even today is actually sub $8,000 a day. And that is a factor of the attractive credit facility that we just put in place. We effectively have no amortization required because we have been paying down debt aggressively. Now that doesn't mean we're not going to continue to pay down debt. As I said, we're targeting 250 by the end of the year. So I would say I'm not sure who has that kind of low break-even rate in the peer group at this point. And obviously that allows us to again to implement the dividend model. And I think that's one of the biggest differentiators. Though having said that, you know, I will say all these, you know, within the peer group, whether it's Star Bulk or Eagle or Golden Ocean in dry bulk, these are all high quality companies. And my guess is investors are really buying baskets of these more so than focusing on one company. But Genco still has the value strategy, and we are very much focused on the long term for the company.
If I can just also just comment on that, of course. Yeah, so we have, as I said, 12,700 for our capes. So obviously they are making 75,000, while the handies and ultras are making 40,000. So yes, there's a bit higher break even there, but certainly a larger upside. And for our Kamsarmaxes, we have a break even of 8,600. And again, with a larger upside than a smaller vessel. So just to put that straight, but arguably both ourselves and Genco have extremely attractive cash break-evens. So I don't think we need to sit and fight over that, John.
We could talk about new buildings, Ulrik, if you like.
Yeah.
No,
John, just quick follow-up. I mean, you guys were kind of first out with a very clear statement on the dividend, and indeed an overall capital allocation strategy, kind of at the beginning or earlier in the year. What kind of feedback are you getting from investors on that? Is that something that, you know, they appreciate? Obviously, the cash flows are good right now, so that's helping. One question there, and also, you know, how do they react to the ESG type of, you know, ratings, and how big a talking point is that for them?
Well, look, so I'll say a few things. One, we had a very positive reaction to the strategy that was announced. Clearly, it's not something that has been tried in dry bulk in terms of driving valuation, and ultimately, our view is once the dividend becomes seasoned, that people recognize that this should hopefully trade more off of free cash flow yield or dividend yield, rather than everybody focus on NAV over and over again, which is a continuously moving target. So that is one of the major factors is driving valuation. On the ESG front, I think, look, it's obviously very important to some investors, and quite frankly, other investors don't ask us questions on it. But as a company, we feel the governance side is very important. The environmental and the sustainability side is obviously front and center. I did a panel yesterday that was very interesting on that. And I do think whether it's banks or investors or charterers for that matter, because charterers, let's not forget about charterers, they're going to drive this quite a bit, maybe even more so than investors and banks going forward. What the thing I would say, Ted, real quick is, you know, while we have very favorable feedback from investors on the dividend strategy, I'm still perplexed as to why all of the equities are trading really below NAV right now. It doesn't make any sense to me. And the reality is, even though cape rates are coming down, they're still at very elevated levels. First quarter looks like it's going to be one of the strongest we've seen in a decade. So the cash flows are still excellent. And these equities never ran up and priced in the $80,000 a day cape rate. So I'm very perplexed as to why things are trading the way they are right now. I think everybody's NAV is going to be a surprise to the upside by the time we get to the end of the year.
And of course, John, if you want to talk about my new buildings, I assume you mean you're interested in buying them. Then they're up about $1 million since we bought, so we can take that conversation offline.
Fantastic, Ulrik. I will say we're setting up a hotline for owners so that whenever anybody wants to order a new build, they can give us a call and I'll talk them out of it.
I don't think you won't be the only one. So George, let me get to you then on the question of differentiation. I think you've addressed it pretty substantively in your earlier comments, and it offers a very interesting and thoughtful way of looking at what, at least in my experience, the default position is, from an investor point of view, pure play is the right way to go, and the way Ulrik kind of summarized it is that's kind of, I think, very standard thinking, and doesn't mean standard thinking is always correct or that things can't be changed. Have you on the back of the announcement you've made, have you gotten any feedback from investors around this transaction, and how do they feel about your views that diversification offers them a better and more sustainable play, and maybe a different trade? It's more of a world economic growth trade than any one sector.
Yeah, I think we had a few meetings at the conference, a few one-on-ones with investors. So far, the feedback we have been getting is very positive. But you can also see that it has been reflected in our share price, which has gone up since we announced the transaction. One thing I want to say in terms of investors, I understand that short-term investors, they want to play the cycle, so they want to invest at the cycle where they feel there is upside and it's going up. Currently, dry bulk is probably the sector that's in fashion. But I want to remind you, because Navios has been public for over 15 years. When Navios went public, almost the entirety of our investors were long-term institutional funds. Now, these funds have gone away when the market disappeared and we had a prolonged downturn. But these are the type of investors that we are trying to attract back to our stock now. And that's why I said earlier, we have created a platform which is a proxy to world trade and the global economy.
Terrific. By my clock, we have 2 minutes left. I don't know if that's enough time to really squeeze in another question. So I think maybe we'll just wrap it up here. And I want to thank each of you guys for your contributions and participation on this panel. I think it's been a thoughtful discussion. I think there's exciting times ahead for us. And I think with the challenges that shipping has ahead, from my perspective, it's quite comforting to see individuals like yourselves, and the peers I know you have with you in your respective companies, driving your companies and the sector forward. So good luck to you all, and thank you again.
Thank you, Ted.
Thank you to everybody. Great panel. And Ted and I have been discussing about this idea of putting this panel together that talks about strategy. At the end of the day, I think the investor universe is a huge investor. It's a huge universe. And different investors have different strategies. So I think what investors want is options. And clearly this panel is presenting investors with different options, good options, and let them analyze, in their own way what, which strategy they want to go for. But having a corporate strategy and putting it out the way you did, I think is the cornerstone. And thank you very much for being with us today.
Thank you very much.
Thank you.
Thank you.
Thanks,
Thanks,
Nicholas. Thanks, Ted. Thanks, Annie.
Bye, guys.
Thanks, guys.
Bye-bye.
Here, guys.
Bye-bye.